Good Monday morning and welcome to Connect, the California MBA's weekly podcast featuring one-on-one interviews with movers and shakers in the mortgage industry. I'm Dustin Hobbs, Communications Director here at the California MBA, and it's August and we're continuing our series focusing on some of the leaders in the residential lending space, talking to them about their experiences, their thoughts on where the industry is at now and where we're headed later this year and into 2022. We've got a great guest and we'll jump right into the conversation here in a moment. But first, let's thank our sponsors over at Incelerate. So Incelerate helps lenders close more loans through better borrower engagement. They are the mortgage industry's most innovative consumer experience platform, and the experience platform delivers lead management, sales enablement, engagement, a robust mortgage-specific content library, and data intelligence all in one comprehensive and highly scalable platform. Incelerate delivers dynamic technology, strategy, and content for every channel of your business to ensure engagement throughout the customer journey, whether that be with your borrowers, your referral partners, or any other party to the transaction. The dynamic enterprise solution seamlessly fits into your existing tech stack, whether that's phone integration, your POS, LOS, servicing system, your data enrichment, and that's due to the advanced API connectivity, modern design, and open architecture. So gone are the days of managing multiple and separate systems like your CRM, marketing automation, lead management, and having your data trapped in those silos. The innovative platform at Incelerate allows you to provide your internal and external customers timely, relevant information based on data intelligence to build repeatable outcomes at each stage of the customer's journey. So bottom line, close more loans, improve borrower conversions, enhance customer retention, transform your customer acquisition lifecycle, and create customers for life. So for more information, go to incelerate.com, or you can call the number listed here in the description below. All right, let's jump into the conversation. I'm excited to welcome in an old friend of the association, Chuck Iverson. Chuck is the president at McDuffie Mortgage Company, and he's been a longtime member of the California MBA Board of Directors. And we'll get into some of the other things that Chuck has done for the association here in a few moments. But Chuck, welcome.
Thank you. Thanks for having me.
Yeah. So let's start at the beginning. For those that maybe don't know you well, I think, I don't know how small, vanishingly small that number is. Chuck, you've been in the industry for a while and everyone seems to know you. But for maybe those that don't know yet, what's your background? How'd you get started in the industry, and kind of what led you to where you're at now at Mason McDuffie?
Yeah. So I was fortunate enough. I had a bunch of friends to get in the mortgage business, and I was in the tech world coming out of college, and worked for a couple startups, and both of them cratered due to lack of capitalization. And one of my good friends was just really doing well in the mortgage industry, and he said, "Hey, come over, I got a desk for you." And so refis were starting to happen. It was 1992, and he set me up, and away I went. And I took to it really, it was just like such a great fit for me because I've been doing technical sales. And I got over here and I just looked at this and I said, "Oh, this is just technical sales. You can be a consultant. You advise your clients, you just have to know your stuff." And so, I got out the 4155 and a highlighter and read it a few times and started taking loan apps and made a few screw ups along the way, but seemed to do okay. So that's how I started.
I'm curious, back in that in the time when you first started, you said you came from the tech side. I mean, obviously in the 90s, the mortgage industry was not exactly technically proficient. Did that kind of chafe at you as you got started in the industry, not having necessarily maybe all the technology certainly that we do now?
Well, I mean, this is a long time ago, so PCs were just becoming a thing at the time. So it wasn't like really technology had proliferated the way that it was. It was mainly in the big corporations and with big mainframe types of things. So, it wasn't as much on my radar really. Probably the most surprising thing to me today, if you would have asked me back then, would we still have, a very complex process and take this many people to produce a mortgage, I would have said no, or 10 years ago, or 20 years ago. So it is just amazing how complex, how many little interactions, how many pieces of data, how many compliance rules that we have to manage. And that's really what keeps this process from being a lot more seamless and simplistic. So, but lots of people are trying to crack the code on it.
Absolutely. So looking back at this last year plus now, obviously, it's certainly been a challenging year for everyone. Everyone, I think, has learned many lessons. So, from your perspective, whether it's personal or professional, what's maybe the most important lesson you've learned?
A couple things. I mean, the first is being flexible. I've had a couple different roles now after a 20-year run, so that's a flexibility I've had to learn. I've had to learn new systems and new companies, and then at the same time, how to do that, with COVID. And the second piece of that is really kind of the importance of people and how we connect. Just in this year, being able to get back out and see branches and meet people, it's just been great. However, the lessons of 2020 are still there using Zoom, or at my current company, we use Microsoft Teams, which is just a fabulous tool. And so now we've got this really engaging kind of hybrid, community right now. And so we like to get together a little bit, but Teams is just, I mean, look at you and I right now, we're having this conversation, we can see each other, it's dynamic. So I think embracing the technology, being flexible and innovating, learning new ways to collaborate, because at the end of the day, this is still a people business and we have to work together.
Have you found it difficult or challenging, or maybe what's something you tell to somebody stepping into maybe an executive role, trying to balance the in-person nature of the culture at a company, and sort of like you said, embracing the technology and being okay with the remoteness of doing Zoom or Teams?
Yeah, I think it's just a mindset that you have to make the best of it, and you have to be willing to learn. And it's tempting as you get older, to not do that, to even if it's just a little bit, grouse about, oh, why do I have to do this, or those types of things. And I feel that disempowers you or takes away from that. So for example, I'm new to Teams, right? And we've got different topics and threads, and now all the files are in there, the meeting notes are in there. So in the past, where I might go, oh, what happened in this meeting? I'll go back to the person who was responsible for it and have them dig out all their files, which is really inefficient for them. It was convenient for me. Now I'm training myself. Okay, I just go right into that folder. It's all the data's right there. So I think that it's making sure that you're willing to do the same thing you ask your teams to do, and that you put a positive spin on it in your mind. Not necessarily out of your mouth, but in your mind, and you just really embrace it.
Continually talking to and convincing yourself, huh?
Yeah.
So I'm curious, having gone through the 2008 financial crisis, I'd be curious to know if there are any lessons you learned from that, or anything you picked up from that maybe prepared you for what we've gone through the last year and a half.
Absolutely, and in 2008, everyone remembers the implodometer, and we were having daily huddles as an executive team, and it was really, a lot of it was around liquidity. Is there someone there to buy these loans that I'm doing? And so we were, was it Sierra Pacific at the time? Great president leader there, Jim Cafrani, and John Giese running capital markets, and we were just like huddling. We were killing products, and we were also taking, if we could sell loans, we were selling, right? Regardless of the price, all those things. So Jim always taught me liquidity is your number one, concern. Whether it's warehouse capacity, or if it's just multiple investors to buy loans, and so we went through that, and of course the other thing is communication and trust with your warehouse partners. We were giving daily updates to our warehouse partners during that time frame, and I personally know other major companies that they may have been taking proactive actions, but they weren't talking to their warehouse partners, and they were shut down by their warehouse partners. So fast forward to last year, and I was with another, incredibly great executive team at Evergreen Home Loans, another great leader, Don Burton, and just, really veteran leadership team. And we, honestly, it was just kind of like we hit the playback button, because it wasn't just the margins. There was really kind of three factors we had to look at. We had margin calls going on, we had forbearance and forbearance modeling going on, and then you had investor liquidity, and the non-QM space, anything that was non-agency literally dried up, and so it was overnight. And so it was like, whoa, Groundhog Day for 2008. But those of us who've been through it, just kind of like, you just kind of knew the playbook of things to go through and prepare the organization to get through it.
Interesting. So you mentioned the margin call issue, and that was roughly around like March of 2020. And I'm curious your thoughts on this. I think for a lot of folks that were not in maybe an executive role or sort of close on the sidelines like I was at the California MBA, kind of watching and seeing how that was all going down. I think a lot of people don't realize what a big threat that was to the industry and how tense of a week or so, or even through that weekend, how big a deal that was. So, I mean, maybe describe for a minute sort of what that was like going through that and how big of an issue that really was.
Yeah. So, everyone thinks rates going down is a good thing, right? Always a good thing. Well,
You're buying a house. Yeah.
When it goes down so far and you have so many locks and your market positions are such that you have to basically put up cash to cover your positions, it's threatening. It's life threatening because you can. There's another piece of it. I highlighted the liquidity lessons I've learned in the past from some of my previous leaders. There's the cash issue too. And so, you can run out of cash, and even if you're a highly going profitable entity, you're done. So for us at Evergreen at the time, Don, again, he's just belts, suspenders, and a piece of rope. So he made sure that we had the ample liquidity there, and really was drawing upon every source that he had to make sure that he was prepared for whatever. So that was probably easier for us, but we were definitely doing the modeling out. And I think that once the Fed realized the problem was, and they tapered the buying, and it was a predictable process and gently lowered, it was all great. But if you remember, it wasn't just margin calls going on that time. We had the liquidity crunch. I mean, we got left with a couple loans from certain investors, and then we also had the forbearance modeling going on, and no one knew how big forbearance was going to be. You didn't know exactly what you were going to have to remit to the agencies, so there's all kinds of just different numbers there. So a lot of spreadsheet calculations going on throughout the industry.
Yeah, I can't imagine the forbearance issue, how much of an unknown that must have been to sort of model that out when, I mean, this is again like a once in a century thing.
Yeah, we were trying to model up to 50% or 100% forbearance even.
Yeah, I mean, thankfully, I think we topped out industry-wide somewhere around 8-9%. But yeah, that not knowing what was going on or what was to come, that I can't imagine the unknown, how much that must have challenged you guys.
Yeah.
So I know that you've been, for those that know you well, they know that innovation is a big value of yours and sort of a passion of yours. And you were certainly instrumental in helping us launch the Mortgage Innovators Conference a few years ago. You're the chair the first couple of years, and certainly very involved as a board member and as the chair of that conference. And so I'm curious from your perspective, where are we at industry-wise when it comes to innovation right now? And maybe where do you see maybe the next big breakthrough?
Yeah, it's really interesting. I've had a chance to kind of step back and think about it. So where are we at? I mean, God bless the entrepreneurial spirit of actually humanity, but in this country in particular and our industry, because there are so many companies trying to solve either large or small problems in our industry right now. But as I said in the beginning of it, it's a very complex environment, and a lot of people outside the industry just think we're a bunch of knuckleheads and we don't know what we're doing. And they're, you always hear this new company's going to come in and just kind of redo the entire mortgage experience, and they don't know what they're doing, and you have to take some of that with a grain of salt. But every aspect of the industry is being modernized right now. It is this is one of my reflections on it. I think one of the biggest barriers to the advancement of the industry has been the volatile nature of it. So, in like 2020, unfortunately, fortunately for the mortgage industry, unfortunately for the economic crisis that was around it, we were super busy. How much innovation do you think went on that last year, besides figuring out how to do work from remote? That was the biggest thing. but it put the brakes on all kinds of things. You know, I know at my current company, Mason McDuffie, there were a lot of modernization projects that just got absolutely put on hold. And of course, we're re-engaging today. Likewise, 2018, people were pulling the plug on all kinds of projects, right? You know, it was all about, because it was so thin margin-wise. And I was at a conference with Tavant, and forgive me for forgetting her name, it was the former CIO of Caliber, who prior to that, she was the CTO of Pepsi, and they asked her what the biggest difference between Caliber was and Pepsi, and she said, "Oh, it's predictability of revenue." You know, Pepsi could engage in long-term projects because they could always forecast their revenue and market share and all those other things. And we're like this, right? And then I look at some of the companies that they're mortgage companies. They came in with a promise of being different, and so they had a lot of investment money behind them, and it wasn't really they didn't have to be profitable the way the rest of us did. And what's happened for them, it gave them a longer runway, and then of course they hit a good market, and so all of a sudden now they're a legitimate environment, or a legitimate contender in the space. So it's just kind of interesting to see the funding and the long-term investment actually pay off, where the rest of us, we're worried about our warehouse covenants and making money and all the payroll and all that other stuff. So anyway.
Yeah, it'd be interesting to see when those, when patience runs out, and with some of these newer companies that obviously, like you said, they came in at maybe the greatest time ever to start a mortgage company. And once things, turn away from refi, if they haven't really invested in their, purchase business, what happens then? And to that end, I mean, this is kind of feeds right into my next question here. What's your thoughts on strategy-wise when it comes to making this transition back to purchase that the industry seems to be slowly making right now?
Well, I think, it's all about your business model. So, we have seen, our friends in Detroit at Quicken do a better job continuously of trying to put out tools to referral partners and get confidence in that community, but it's been slow going. Still, they're so good at what they do that they're making progress. But for distributed retail companies like myself and some of the companies I've worked for, and many of the listeners are out here, it's just the loan officers getting out with their referral partners, and that's what's really keeping us in business. And I was talking to actually my friend Jeremy Potter, who you may know from Quicken, a couple weeks ago, and there's still a conversion issue in our industry. So we can engage borrowers, we can get them advertising, we can give them content, and and do a lot of things around and educate them. Look at Zillow; they've got everybody looking at real estate. Redfin, same thing. But getting that actual conversion is still somewhat elusive, except for at the time of sale between that referral partner and a trusted originator. So will it stay that way forever? I don't think so. But there is there's such value there, such expertise. And again, when you actually get inside of a transaction, you go, wow, there's so much that could go wrong on one of these things. There's so much to know that highly experienced mortgage originator is really still the best purchase vehicle for a consumer out there. So, I've been blessed to work with some of the best, and I've got some of the best right here at Mason McDuffie, excuse me.
Yeah, I'm curious, how much do you think that the borrower, him or herself, plays into this? As far as if you've got a really, experienced borrower, this is not their first house, they know exactly what they want, they can kind of, they've got all their paperwork together, they can kind of almost do it, as a matter of, just a piece of cake, they can go online and do it, and they don't really need their handheld. And then you've got the first-time home buyer that, maybe even says, a younger borrower even says they want to do it all online, but when it comes down to it, they don't know what they don't know, and they really are going to lean on that originator as a trusted source of information.
Yeah, you're talking about Dave Zitting talks a lot about this, about the emotional needs of the customer, both from a knowledge and from what I would call a hand-holding. And certainly there's those borrowers that are more sophisticated. I mean, gosh, many have done so many loans now, so they know the process and all that. I still think on purchases, they're going to have a tendency to go to a referral. I think their financial institutions are becoming a stronger play. I see credit unions really on the move, as well as the depository. So they're pretty strong and fierce, and that's one where they can kind of get in there because they have that trusted relationship too. But even the veterans, even myself, in a transaction, again, I need somebody, a partner on the other side that really knows what they're doing, and I just went through a transaction, and I have a friend who's an originator, and I just appreciate the level of confidence that went into that whole thing, and it could have just gone a completely different way. Now I know that because I know the processes, I know what I'm talking about in all those other things. I wouldn't have had the control though. I would have been on the outside just being really frustrated. So, I think it's still originator dependent so much on their competency.
It's hard to put a number on peace of mind, right? So looking forward here to next year, sort of maybe the end of this year, next year, what as someone who's leading a mortgage company right now, what maybe single economic factor do you pay attention to more than anything else, other than interest rates? Obviously, is there something on a macroeconomic level or something else in maybe in housing specific that you really kind of pay attention to every day, or a couple of times a day?
Not really. I mean, if you're talking about the trends for next year and what I'm thinking about, it's really housing inventory, and I think that's really the big question. And certainly, interest rates may be volatile. I don't think we're going to have, we're not going to go to 8% rates. So I certainly expect at some point we're going to have rates go up, and that will, I think margin compression, as well as lower volume is going to be a real issue, whether it's in 2022 or 2023, one of these years coming up. I think we will be the benefit of a pretty good purchase market though through all those years, just because, I mean, the pin-up demand of the millennial generation, and we haven't even been talking about the next generation, which is my son's age, and he's 25 now, and so he's doing well, and other kids that are going to come up, and they're going to be of that age of buying. So there's such demand out there, and oops, my lights just turned off. The inventory just doesn't come like that. So I think condominiums, I think new construction, I think that a continued move towards lower cost housing, so out here, I'm here in California, so I'll point out towards the valley, those things, Nevada, Arizona, other states. I think eventually it was like the Midwest looks like a bargain, and it's a great place to live, And so I think that, the hybrid workforce and being able to, work remotely is going to start some more migrations away from some of the high cost markets. So, those are some of the macro trends that I think about,
Do you see any relief when it comes to inventory? I know just recent data that's come out, I think from the realtors last week or a week before, looked like there's a little bit of relief. But do you see that as maybe a long-term trend that's happening now, or is that just kind of maybe a blip and we're still going to have really tight inventory for the foreseeable future?
Yeah, I think we're going to have tight inventory for the foreseeable future. Hopefully, it's not going to be excruciating the way that it has been, because it's been so tight that in some markets you can't even get financing contingency. So that just locks out normal folks buying a house. And of course, just the spike in prices, that's another affordability issue. So it's concerning. I'm concerned for my staff members. I just think about it right here. I'm in the East Bay area, which is a beautiful area, but now has became prohibitive in costs, I think, for a lot of people that aren't tech billionaires. So, it's a concern, a real concern for the industry. But I do think that we're innovative, we'll find ways of doing this. People will adapt, people will move, and we'll be there to serve them.
Yeah, makes sense. So last question here, we're starting to run out of time. I know you've been, I mentioned earlier that you've been a board member of the California MBA for a number of years. You've been involved in the association's activities for a long time. I think you're a good person to ask this question. I mean, if you're talking to a fellow lending executive or someone, or colleague in the industry who's not yet a member, what's your pitch to them on why it's important? Why have you, when you've kind of moved throughout the industry, why have you always made sure that you've stayed involved with the California MBA? What's the gain to you?
Yeah, I'd say it's three things. The first is, once you start paying attention to the legislative environment in California, which is where a lot of mortgage industry regulations start, and you realize the competing forces that are trying to come up with innovative ideas, and I think many of them are well-intentioned, but with kind of catastrophic side effects. And to have the level of reach that this organization has through our lobbyists, who are just fantastic, through Susan. So to have a CEO who's been at the helm for so long and kind of knows the insides of the political landscape there, I think it's just vital for our industry. And we're not just helping California, we're helping the entire country, excuse me. So that's what I look at it. I think the other thing that people need to know is the value that's created. First off, we're all comrades. I can learn from so many different people. And so, the content that's put out, the conferences, Mortgage Innovators, Western Secondary, I mean, these are staples, legal issues. And for our commercial partners out there, we've got a great conference as well. So just really great content, education, resources as well. And then the third, I'd say, is just the quality of the people I've met has just been fantastic. And it's honestly changed the trajectory of my career.
Wow, well, that's great testimony. Thank you, Chuck. I appreciate that. Appreciate the kind words, and thanks for staying involved, and thanks for joining us on Connect today.
Thanks for having me. Have a great year, everybody. Take care.
Yeah. Well, and I assume that we'll be able to see, I forgot to ask this a couple of minutes ago, I'm assuming we'll see you at the Western Secondary here in a couple of weeks, right?
We'll be there.
Absolutely. So we'll be live and in person. For those who aren't registered yet, we're going to be live in person again at the Western Secondary, August 24th through the 26th at the Monarch Beach Resort in Dana Point. It should be a fantastic event. We actually are going to have a all attendee party on the first night that is going to feature Escape the Journey tribute band, and we're going to have some live dancing and fun, and some, I think, some 80s themed costumes will probably show up. So
I'm thinking Jen Roth might be there.
I think she might. I think there's a chance. Yep, absolutely. So if you're not registered yet, make sure to go to westernsecondary.com and you can check out the information there. And we'll be back again next week for another episode of Connect. We'll see you then.